Hey everyone, and welcome back to the channel. Man, oh man, was that a rough week in the stock market that we just saw. Not only in the stock market, but in the economy as well. Let me touch on a few things before we jump into today's video topic. The stock market ended the week with back-to-back 2% plus down days. And on the entire week, we saw the stock market fall nearly 6%. 6% in 1 week is a pretty sizable downswing. Not only do we have the poor stock market performance, but we saw poor economic performance as well, with a couple reports that I'm going to go over here, and there's just not a lot going right in the US economy right now, which means things could get a lot worse before they get better. On Friday of last week, we got the latest inflation report, which was for the month of May. And this report showed that inflation has increased year over year 8.6%. Economists were looking for something closer to 8.3%, which was in line with the prior month, which means things are continuing to get worse. Thus, the sell-off we saw on Friday in the stock market. The growth in inflation is the highest that we have seen since 1981. This is the highest I've seen it in my lifetime. That inflation report that we just got only further adds fuel to the recession talks, or possibly are we already in a recession here in the US? If you think about it, just this past week, we have got reports from Tesla saying they were going to cut 10% of their salaried employees. Stitch Fix came out with a report saying they are cutting 15% of their salaried employees. Amazon and Apple have also froze all hirings moving forward. And this is just a few reports that I'm noting here, but these are sizable companies that are foreseeing trouble in the economy ahead. How the Fed will react to this red hot inflation report is probably going to lead to yet another 50 basis point increase. We may even get higher than that. They may just try and rip the Band-Aid right off because something needs to be done to impact inflation. It's just completely getting out of hand. And they have a mandate now that says we have to do something to get inflation under control. Adding on to that, the 10-year Treasury went above and beyond the 3% threshold and ended around 3.1% when I last looked on Friday, meaning that mortgage rates are just going to increase higher. And this is after a report that we just got saying that mortgage applications were at a 22-year low. So is there a pending slowdown coming in housing as well? Like I said from the beginning, it was a rough week, but it doesn't end there. On Friday, we also got the preliminary June report from the University of Michigan that goes over consumer sentiment. Should I even tell you what this reading was? Before we look at it, take a look at this consumer sentiment chart dating all the way back to around 1980. As you can see from the chart, a rating of around 80 plus, we can call it, is a rather positive thing. You know, it seems like the economy is moving well and consumers have a good feeling. Above 90, they're feeling great about the economy. So with that in mind, the June preliminary report that economists estimated first, I'm going to tell you what the economists estimated first before we take a look at what the preliminary report said. So economists estimated that this June report would have a reading around 59. So let me back up real quick and let me tell you what the May reading was. So the May reading came in at around 58.4. Okay, great. So economists think we're going to get a reading of 59, albeit a slight improvement. It's an improvement. It's progress nonetheless. And really anywhere you look right now, whether it's housing, interest rates, the stock market, we're looking for some progress in the right direction. So if we get what the economists are estimating of 59, albeit a slight improvement, it is progress in the right direction. All right, so let's take a look at this awesome consumer sentiment report. We're going to start improving, and that preliminary report reading came in at 50.2, 50.2. Not even in the same ballpark at what the economists were looking for. 50.2. That is incredibly low. That is actually the lowest that we have seen since the 1980 recession. So we have record inflation, or inflation records that have not been seen for 40 plus years. We have record low consumer sentiment that has not been seen since the 1981 recession. Where do we go from here? Well, let me tell you what I'm going to do. I'm going to be focusing on high quality, cash flowing dividend stocks, companies that are able to return value and return shareholder money, and it doesn't matter about the economic backdrop. I'm going to continue to add to these high quality companies, especially ones where the economic backdrop might not matter as much. No one here, and you will never hear me saying, I think this is the bottom. I think this is the exact bottom here and you need to buy now. Well, first off, I'm not a financial advisor, so I will never be telling you what you need to do with your portfolio. Make sure you always do your due diligence before investing in any stock or ETF, especially ones mentioned in this video. But I'm never going to sit here and call the bottom. Calling the bottom is just, it's a matter of luck. But I'm going to continue to add to these high quality positions that I cover in these videos, because when things turn and we get that progress back, I think they're going to be swift and it's going to turn quickly. And you're going to wish that you were adding to these positions. Don't let a year go by and you look back and say, man, I wish I added back in 2022. That was the perfect time when stocks were diving deep and I could have just slowly been adding instead of trying to time the exact bottom. With that being said, we are going to take a look at businesses that fit this exact description that I'm talking about. In fact, we are going to take a look at the 10 highest quality REITs for you to consider investing in your portfolio. I have received a ton of positive feedback on my REIT video, so I wanted to give you one where I go through what I believe to be 10 of the top REITs on the market today. So if you love REITs, you love dividends, and you love passive income, then do me a huge favor and click that like button down below. And also, if this content interests you, then hit that subscribe button down below as well so you are notified anytime we drop a new video. Before we get started, I have a huge promotion to tell you about. Down in the description below, I will drop a link to WeBull. If you sign up for a new account at WeBull, they will give you 2 free stocks that could be valued up to $3,000 per share. So definitely don't let that promotion slip away. Check out the link down in the description below with WeBull. All right, let's jump into the video and go through what I consider to be 10 of the highest quality REITs in the market today. As we go through these, we're going to go through a few items. We're going to go through quickly the business. What kind of industries are they in? What type of properties do they own? We're going to take a look at the chart, take a look at the dividend, and touch on valuation. These REITs that we're going over is not a top 10 buy now list. I just want to clarify that because we're going to be going through 10 of the highest quality REITs. So some of them may not be in my what I consider a buy price right now. So I'm going to go through those and I'm going to show you comparisons to 5-year averages. I like to look at a 5-year average and kind of see where the valuation lines up right now. So don't get confused thinking this is a top 10 buy now list. This is a top 10 high quality REIT list. So these REITs, as we go through, they are not listed in any particular order. However, we are talking about REITs. So the first REIT I have to start with is probably the most popular REIT on the market, and it is otherwise known as the Monthly Dividend Company, aka Realty Income, stock ticker O. As you can see now here, we move over to the chart. Realty Income is trading around $66. Over the past year, shares of Realty Income are down 4%. They've traded within a 52-week range of $62. So right now we're trading very close to that 52-week range and as high as $75. The price to FFO currently is 16.6. So keep that in mind when we take a look at the fast graphs chart here in the next slide. The company pays a dividend rate of 2.96, which equates to a dividend yield of roughly 4.5%. The company has a market cap of $40.4 billion. Looking at the dividend here, as I mentioned, you have a dividend yield of roughly 4.5%. And don't look at the payout ratio because Seeking Alpha does it differently here. They're going to look at EPS. Remember, when you're looking at REITs, you want to look at an FFO payout ratio, much different than regular dividend stocks. You get roughly about a 4% per year dividend increase, and the company has increased the dividend for 25 consecutive years now. So Realty Income is one of the newer in the past year additions to the Dividend Aristocrat list, meaning they are part of the S&P 500. They have met the market cap requirements, and they have also increased their dividend for 25 consecutive years. So again, they're called the monthly dividend company, and that just means that they pay a dividend each and every month. Turning over to the fast graphs chart, which is going to closely look at this blue line down here, is going to kind of tell you where the FFO or the AFFO has traded. Remember, with REITs, we're not looking at EPS. We want to look at FFO or AFFO. And what that stands for is funds from operations. So for me, I prefer AFFO. That is going to be the most comparable, the best comparable, I should say, for when it comes to REITs. So over the past 5 years, you can see that shares of Realty Income have traded close to 20 times AFFO. Currently, shares, if we look back for Realty Income, they are trading, let's take a quick look back here, at 16.6 times. That's on a forward-looking basis also. So right now, shares look pretty good for Realty Income. We have seen the dip in the stock here. The second REIT we're going to look at today is STOR Capital. I like to consider them as the little brother to Realty Income, also a net lease REIT. And I should explain that real quick. What a net lease REIT is they go out and they buy the real estate, and then they lease it to a tenant. But they also pass a lot of the normal landlord costs over to the tenants as well. So think of insurance costs, think of property taxes, think of capital expenditures, and much more. All of this is the responsibility of the tenant. So really, someone like STOR Capital, someone like Realty Income is just going to be collecting a paycheck, a rental check each and every month. So the REITs are a little bit different. Realty Income likes to focus on more of an investment grade tenant, which investment grade tenants give you safety. You know a little bit more about their track record. That doesn't go on to say that STOR Capital doesn't focus on safety or investment grade tenants, because they also have a large investment grade tenant base, but they like to focus more on middle market as well. And that's kind of their niche. So that's really where they differentiate themselves. So STOR Capital is very similar to Realty Income in many ways. But over the past year, a lot has gone on at STOR Capital. Actually, I should mention that Warren Buffett at Berkshire Hathaway was invested in STOR Capital, had shares in STOR Capital as his REIT in the Berkshire Hathaway portfolio. So STOR Capital has got the stamp of approval from Warren Buffett. But over the past year, shares are down nearly 30%. You can see it is a rough chart here. We saw the abrupt exit of the former CEO and co-founder Chris Volk, someone who I have talked to on a number of occasions and I believe is a great leader. He was one of the main reasons that I invested in STOR Capital. So over the past year, STOR Capital has traded between $25.62 and as high as $37. So we are trading right at the 52-week low, making it seem like STOR Capital right now could be a good stock to have on your radar. Right now, the price to FFO for STOR Capital is 12.3 times. So let's keep that in the back of our head before we look at the fast graphs. The dividend is $1.54, which equates to a dividend yield of 5.8%. That is a great dividend yield right there. And we'll quickly look at the dividend stats. You see your 5.8%. And on the year, you're getting a little bit more dividend growth. You're getting roughly 6% per year in dividend growth, and they have increased the dividend for every year that they have been a public company so far. So let's quickly go back to the summary, and we're going to see the price to FFO is about 12.3 times. Let's see where they've been over the past 5 years on average. 16.5 times, you can see right over here. So over the past 5 years, shares of STOR Capital have traded at a AFFO closer to 16.5 times. Right now, they're trading closer to 12.5 times, making it look like shares of STOR Capital are trading at a discount. The third high-quality REIT for you to consider for your portfolio is WP Carey, stock ticker WPC. WP Carey is actually a REIT that I went through on a prior video, so definitely check that out as well. But they are a little bit different than Realty Income and STOR Capital, who are a little bit more focused on retail. WP Carey is actually more focused on industrial and warehouse. They do have some office. They also have some self-storage among other property types. They are a very well-diversified REIT that has a very strong portfolio, but an emphasis on warehouses and industrial. WP Carey, over the past year, shares are actually up. We're talking about a company that has seen shares increase with all the negativity that we've seen in the market. WP Carey has eked out a 7% gain over the past year. The shares have traded between a range of $73 and $86. So we're starting to creep up closer to that 52-week high, still roughly about 5+% away from that. In terms of the FFO, price to FFO, trades at 16.1 times. You're getting a dividend of $4.23, which equates to a dividend yield of 5.2%. So again, a very solid dividend yield that you are getting here. And let's quickly look at the growth. Pretty much non-existent, a 1.3%, but we're hoping there's a lot of headwinds for WP Carey in it. And definitely check out that last video that I did where I covered WP Carey and talked about how a lot of their 99% of their leases are linked to inflation or CPI. And as I just mentioned, inflation is red hot right now. So those are some major tailwinds for a company like WP Carey. So again, we're trading at a price to FFO of 16 times, and over the past 5 years, we have traded closer to 14 times. So it could look right now like shares of WP Carey may look a little bit inflated, but I don't believe so, because the company 5 years ago is much different than the company we see today. WP Carey actually had a management arm, which is kind of winding down right now, and they weren't as focused on warehouse and industrial. If you look at some warehouse and industrial REITs right now, their valuations are closer to 25 to 30 times. So to have WP Carey trading at 16 times feels like a steal to me. At the very least, I believe they should be trading at north of what something like a Realty Income has. This company has very long-term leases, weighted average leases in the double-digit years. They're seeing strong free cash flows that continue to increase, which should also increase the dividend moving forward. So definitely take a look at WP Carey. The fourth REIT we're going to look at today is one of my favorites and also one of my largest REIT holdings, and that is VICI Properties, stock ticker VICI. And over the past year, it has been a little bit of a roller coaster. Shares of VICI are down roughly 9%. Over the past year, shares have traded between $26 and roughly $34. So we're a little bit closer to the bottom end, but really in the middle there. In terms of price to FFO, we're trading at 16.2 times. We have a dividend of $1.44 paid annually, which equates to a dividend yield of 4.7%. No dividend growth rate is shown here. That has really been non-existent, but the company has also made a lot of changes similar to WP Carey. This year, the company is now the largest owner of real estate on the Las Vegas Strip. So this company, unlike the other ones we've looked at, is in the gaming and hospitality. So think of the MGM Grand, New York, the Luxor, now the Venetian, and also many other, think of Excalibur, many other hotels and casinos right there on the Strip. But they're not just in Las Vegas. They're spread out all over. They have a Harrah's in Laughlin. They have stuff on the East Coast as well. So they are one of the largest owners of casino and hospitality properties, and they have been doing quite well. As I mentioned, shares of VICI currently trade at a price to FFO of 16.2, and turning to the fast graph chart, over the past 5 years, shares have traded closer to 16.5. So right now, things look relatively fairly valued. So definitely take a look at shares of VICI Properties. The fifth high-quality REIT we're going to look at today is one you already might be very familiar with, and that is Simon Property Group, stock ticker SPG. Simon Property Group is the world's largest mall owner, mall landlord. The company has an A-rated portfolio, meaning they have sales per square foot from their tenants, which are top-notch. We've heard a lot of pressures and a lot of malls that have actually closed doors, and gone into bankruptcy. But this also goes down to, these are B and C or less rated malls. These aren't A-rated malls that are shutting. There's a lot of outdoor malls now that are actually performing quite well. We're seeing traffic numbers tick up for different mall locations in the Simon Property Group portfolio. Over the past year, shares of Simon Property Group have really been on a roller coaster. We saw a big upswing at the end of 2021, but now shares have been under intense pressure, especially if talks of recession are pending. And over the past year, we have seen shares down 24%. If we quickly look at what it has been over just year to date, we're looking at a loss of 37%, which is astonishing for a company like Simon Property Group. The company has traded, they're trading right at their 52-week low at 101, and which what they hit today, and they have a 52-week high of 171. The company trades at a price to FFO of just 8.9 times. So we are in the single digits now. They pay a dividend of $6.80. We've seen some big dividend growth from them of late, which equates to a yield of 6.6%. That is astonishing. This company has the potential for some stock appreciation if things swing back up, and it's also giving you a great dividend yield at current levels. Looking at the dividend quickly, they have seen growth of 3.5%, which of late has been much higher. Let's take a look at where the company has traded the past 5 years. 15 times. So Simon Property Group, over the past 5 years, has traded at a multiple of 15 times, and right now we're talking about them below 9 times. So definitely a potential to grab shares of Simon Property Group on the cheap. Next, moving ahead here is Prologis, stock ticker PLD, and they are one of the largest industrial REITs on the market today. On the year, they are down 7%. They've traded right at their 52-week low, which is $116, and they've traded as high as $174. So you're seeing a trend here where REITs, along with the broader market, have been hit of late. They traded a price to FFO of 23.7 times. This is one of those industrial REITs that I was talking about when you compare to WP Carey, which was trading at 16 times. This REIT is down. You could see how much it's been down over the past month. Just in the past year, they're down 29% and still trading at a FFO multiple of 23.7 times. So you can see the disconnect there. They pay a dividend of $3.16, which equates to a dividend yield of 2.6%. All right, so we're at 23.7. Let's take a look at the fast graphs chart to see where we have traded 28 times over the past 5 years, which now shares are starting to look, they reached a high over 30 times just a few months ago. Paying for an industrial REIT over 35 times just seemed outrageous. So this was a much needed pullback, but with the pressures from the broader market, things got a little volatile here for Prologis. Next, let's take a look at one of the largest apartment REITs, and that is Avalon Bay Communities, stock ticker AVB. Over the past year, shares of Avalon Bay have actually done quite well, except for, again, of late. Shares are down 9% on the year, but if we look at year to date, shares are down 23%. The company pays a dividend of $6.36, a yield of 3.26%, and the current FFO valuation on a forward-looking basis is 20.2 times. Over the past 5 years, shares of AVB have traded closer to 22.3 times, indicating that these shares are now also starting to look a little reasonable as well. Just a few months ago, back in April, we were looking at shares of AVB over 30 times. So really, it was just a combination of things, especially REITs getting a little bit outstretched, these high quality REITs, and then market pressures, talks of a recession, everything has kind of come falling back to earth. The eighth REIT we're going to take a look at today is the largest self-storage REIT, and that is none other than Public Storage. Many of you have probably seen this REIT on the road, their bright orange self-storage facilities, and that is stock ticker PSA Public Storage. Currently, those shares over the year are up, and you can see that over the past month, they've been under pressure as well, but they still eked out a gain over the past year of 4%. The company pays a dividend of $8 per share, which yields a little below 2.6%. In terms of valuation, we're looking at a price to FFO of 20 times. And over the past 5 years, shares of Public Storage have traded closer to 22.8 times, again indicating that shares of Public Storage may be something to look at on your watch list. The ninth high quality REIT for you to consider for your portfolio is Digital Realty Trust, stock ticker DLR. Now we're going to move more to the technology or I should call it the data center. This is one of the largest data center REITs, and if you think about it, everything is moving to the cloud. You have Microsoft, Amazon, Apple, all of these companies are involved in the cloud. Many folks, many businesses are having work from home opportunities now, which need more cloud space, more cloud capability. If we zoom out a little bit, you can kind of see how digital realty has performed. They're up 14% considering, but they reached a high of nearly $180 back in late 2021, but still on the year shares are down 20%, and this is the stock that I am looking at closely right now. Over the past year, they've traded between a range of 124 and 178. They have a dividend of $4.88, which equates to a dividend yield of 3.66%. Quickly looking over at the dividend growth rate, you can see that over the past 5 years, you've seen the dividend increase on an annual basis of roughly 5.7%, and they have done this now for 17 consecutive years, which is nothing to complain about there. We saw some strong dividend growth rates or track record from Realty Income, who had 25 years, and these guys are right on their tail at 17 years. So in terms of valuation, again, I mentioned they trade at a price to FFO of 19.5 times, and looking at the fast graphs chart over the past 5 years, we are trading right under that 5-year rate of 20.8 times. So a lot of these high quality stocks that we're trading, if we look back at the end of the year, 12/31, DLR shares were trading at a multiple of 28.3 times. So a lot of that valuation has come down and things are starting to look undervalued or reasonably valued depending on the stock here. And that leads us to our 10th and final high quality REIT. And again, this is not an all-inclusive list. There's a lot of great names that could be added to this list. This is just 10 that I thought of, and that leads us to American Tower Corporation, stock ticker AMT. And if you are unfamiliar with what AMT does, they build all of the cell towers that are around the US. When you see a cell tower, most of these are owned by a REIT, and most of them are probably owned by either American Tower or Crown Castle, another very large communications tower REIT. But American Tower essentially builds these cell towers, which, we're going through a boom with 5G, so they're definitely benefiting from that, both 4G and 5G rollouts. But then they lease a lot of this coverage out to the likes of Verizon, AT&T, or T-Mobile, just to name a few. Shares over the past year of American Tower are down 7.3. They pay a dividend of $5.72, which equates to a dividend yield of 2.2%. So, we saw a lot of higher yields with a lot of the early REITs that we looked at, but of late, these technology REITs, the data center REITs, you're going to get a little bit less in terms of yield from what we've seen. Looking at dividend growth, this one is you're getting some growth in the stock price and you're also getting dividend growth. This could be considered a dividend growth stock in many ways. Over the past 5 years, a dividend growth rate for a REIT of nearly 19% is pretty awesome. And they have done this for 10 consecutive years. They have increased the dividend for 10 consecutive years now. In terms of valuation, the company trades at a FFO multiple of nearly 25 times, and over the past 5 years, they have traded closer to 24 times. So this one still looks a little bit higher than where they've traded over the past 5 years, but you can imagine that with the 5G and how they're benefiting from that, it probably makes sense that a company like American Tower trades at a premium. After all, they are the largest cell tower owner here in the US. So there you have it, folks. 10. We went through 10 quickly. Hopefully it was quickly. 10 high quality REITs for you to consider for your portfolio. They go through a wide range. We've looked at retail REITs. We looked at gaming and hospitality REITs, warehouse REITs. We looked at data center REITs, or even cell tower REITs, self-storage REITs, mall REITs. I'm sure I missed some, but these are different options for you to consider for your portfolio. But the key is that these are all high quality companies. So keep them on your watch list. Look at the valuations, stay up with the quarterly reports, and take advantage of any pullbacks you get in these high quality REITs. They don't happen all that often. I hope you guys enjoyed the video, and if you haven't done so yet, click that like button. That is huge for the growth of this channel moving forward. And if you like the content, please consider subscribing. Definitely take advantage of that WeBull promotion down in the link below. And with that, we will see you next time. Take care.